Rick Rule's smile. Silver miners. 100% gain boom ignored. A man who built fortunes across 5 precious metals bull markets is smiling. While Wall Street analysts stare at their outdated spreadsheets, silver has surged 74%, from $65 to $113. But here's what they're missing. Mining company profits didn't rise 74%. They exploded by 100%. Same trucks, same workers, same diesel, double the profit. Yet the stocks, trading as if silver is still in the 90s. The math doesn't lie, but someone isn't updating their models. And that gap, that mathematical disconnect, it won't last forever. Welcome to Financial Rewind. If you've spent decades watching markets, reading quarterly reports, understanding that real wealth isn't built on headlines, but on numbers that don't lie, then you're in the right place. We don't chase trends here. We dissect structural shifts before the consensus wakes up. Now, if you appreciate analysis that treats you like the experienced decision maker you are, not like someone who needs motivation or hype, do us the courtesy of hitting that subscribe button. We're building something for serious people, not for the algorithm. And before we continue, drop a comment below. Where are you watching this from? London? New York? Hong Kong? Mumbai? Let us know. We're curious who else sees what we're seeing. Now, let's get into the mathematics. The financial markets are displaying something unusual, something that doesn't happen often. A mathematical disconnect, hiding in plain sight. While experienced investors watch closely, most market participants are missing it entirely. Silver prices have climbed from $65 per ounce at the end of 2025 to $113 in recent sessions. That's a 74% increase. Strong performance by any measure. But here's where the story gets interesting. The companies that actually mine this silver, the producers who extract it from the ground, their profits didn't rise by 74%. They exploded by approximately 100%, nearly double. Same mining equipment, same workforce, same diesel fuel consumption, same operational infrastructure. Yet profits doubled while the metals price increased by 3/4. This isn't speculation. This is mechanical arithmetic playing out in corporate cash flows. And Wall Street, for reasons they'll understand shortly, hasn't fully repriced these mining stocks to reflect this new reality. The companies have rallied 50 to 100% in recent months. Solid gains, but still lagging behind the fundamental profit expansion happening inside these operations. To understand why this matters, one needs to grasp a single concept that separates casual observers from serious resource investors. All-in sustaining costs. Industry professionals call it AISC. It's the total cost to produce 1 ounce of silver, everything included. Labor wages, diesel and energy, equipment maintenance, royalty payments, environmental permits, corporate overhead, sustaining capital expenditures. For most primary silver producers, this number clusters around $16 to $20 per ounce. Some companies like Pan American Silver guide their silver segment AISC at $15.75 to $18.25. Hecla Mining reports costs in the low teens after byproduct credits. Others operate in the mid-20s. But $16 to $20 represents the realistic range for efficient primary operations. Now here's the critical part. These costs are largely fixed. Not completely fixed, but substantially fixed in the short to medium term. A mining company doesn't hire double the workforce because silver hit $113. They're not suddenly burning twice as much diesel per ton of ore processed. The processing plant doesn't require dramatically more electricity. The trucks don't break down more frequently. The permits don't suddenly cost more. The infrastructure investment, the sunk capital in roads and facilities and grinding circuits, that's already in place. The mine operates essentially the same way whether silver trades at $65 or $113 per ounce, which means something profound happens. Every single dollar that silver rises above that $16 to $20 cost threshold flows almost entirely to profit. Not revenue, profit. This is the leverage most investors completely miss, because they're conditioned to think linearly. They see a 74% price increase and assume profits rise proportionally, but that's not how the mathematics work in commodity extraction. Consider the numbers directly. When silver traded at $65, with all-in sustaining costs around $16 to $20, the profit margin per ounce was $45 to $49. Now, with silver at $113 and costs remaining in that same range, profit per ounce has jumped to $93 to $97. The mine didn't change. The ore grade didn't magically improve. The workforce didn't expand. Fixed costs stayed fixed. All the price increase above that cost threshold converted to pure margin expansion. 74% price appreciation, 100% profit growth. This is operating leverage in its purest form. And it's exactly what veterans like Rick Rule have been watching unfold over the past 90 days. He's seen this pattern before. Gold miners in 2005, when gold broke through $450 and producers trading at book value suddenly printed margins that tripled their earnings forecasts. Uranium producers in 2007, when yellowcake spiked and companies with fixed production costs saw profits go parabolic. Copper plays in the mid-2000s, when the same mechanical force turned undervalued mining stocks into 10-baggers. The pattern is identical. Fixed costs plus rising commodity prices equals exponential earnings growth, not linear, exponential. Yet despite this mathematical reality playing out in real time, despite silver climbing from 65 to 113, despite profit margins widening by approximately 100%, silver mining stocks have rallied 50 to 100%. Strong performance, but still trading at valuations that imply silver closer to $90 or $100 in many analyst models. The earnings estimates for Q1 at 2026 are still catching up, built on assumptions from when silver was consolidating lower. Institutional money hasn't fully rotated in yet, because fund managers don't believe this rally sustains, and that disbelief, that institutional hesitation, that's creating the gap, the mathematical anomaly sitting in plain sight. While the profits print, the stocks lag. The question isn't whether the math works. It demonstrably does. The question is why Wall Street hasn't caught up yet, and whether that lag represents opportunity or warning. There's a reason the smartest analysts on Wall Street are sitting on their hands, and it has nothing to do with the mathematics. They can read balance sheets. They understand operating leverage. They see the profit margins expanding in real time. Yet they're not updating their price targets. They're not issuing aggressive buy ratings. They're not rushing their institutional clients into silver mining equities. Why? Because they've been burned before. Badly. And institutional memory, in the investment world, runs deeper than most people realize. April 2011, silver hit $49 per ounce. Retail investors poured into the metal. Mining stocks surged. Analysts scrambled to raise price targets. CNBC ran breathless coverage about silver shortages. Then, within 8 weeks, silver crashed back to $26, cut nearly in half. The mining stocks, they fell even harder. 60, 70, 80% drawdowns in some cases. Investors who bought at the top, chasing momentum, lost fortunes. Fund managers who repositioned their portfolios based on that rally faced redemptions and career risk. The analysts who issued bullish calls at $45 looked foolish when it collapsed. That pain, that professional embarrassment, it doesn't fade quickly. Fast forward to 2020. Silver briefly touched $30 during the pandemic-driven precious metals rally. Once again, excitement built. Mining stocks jumped. Analysts began cautiously upgrading their outlook. Then, silver stalled. Couldn't hold 30. Drifted back to the low 20s through 2021 and 2022. Another false start. Another reminder that precious metals rallies, historically, have been driven more by speculative froth than sustainable fundamentals. So when silver surged from 65 to 113 over recent months, when the technical breakout looked powerful, when retail enthusiasm started building again, the institutional response wasn't excitement. It was skepticism. Not because they don't understand the sector, but precisely because they do. They've watched this movie twice already, and both times, the ending disappointed. This creates a psychological barrier that's almost invisible to outsiders. A fund manager at a major investment bank, managing billions, doesn't get rewarded for being early. They get rewarded for being right when consensus validates their thesis. Being 3 months early, and enduring a 30% drawdown before being proven correct, that's called career risk, not visionary positioning. So they wait. They demand proof, multiple quarters of elevated earnings. Confirmation that industrial demand isn't just a one-quarter statistical blip. Evidence that this time, the rally has structural legs beneath it, and while they wait, the mathematical disconnect persists. Because the earnings reports that will validate their thesis haven't been published yet. Q4 2025 results, showing the first full quarter of elevated silver pricing. Those drop in February and March 2026. That's when Hecla will report profit per ounce that's doubled versus earlier quarters. That's when First Majestic will show margin expansion that obliterates their previous guidance. That's when Pan American Silver will revise their full year 2026 forecasts upward based on current spot pricing holding. But here's the critical insight. By the time those earnings reports hit Bloomberg terminals, by the time the analysts run their updated discounted cash flow models, by the time the institutional investment committees approve increased allocations to the sector, the stocks won't be trading where they are today. They'll have already begun repricing toward the new earnings reality. The easy money, the 50 to 100% gap between current valuations and fundamental profit growth, that gets compressed. Not eliminated, but compressed. This is why Rick Rule is smiling. not because he's smarter than Wall Street analysts, but because he understands the timing game differently. He's built his fortune recognizing that institutional capital, by its very nature, arrives late to structural shifts. It has to. The governance structures, the risk committees, the client reporting requirements, they're designed for safety and consensus validation, not for early-stage positioning in volatile sectors. Rule saw this in gold during 2004 and 2005. Producers were trading at book value, sometimes below book value, while gold climbed from $350 to $450. The mathematics screamed opportunity, but institutions waited. They needed confirmation that the rally was real. By the time they got that confirmation in 2006, the easiest gains were already captured. He saw it again in uranium. Cameco and other producers sat at depressed valuations in 2005 and early 2006, while yellowcake prices began their climb. Institutional buyers waited for proof. By late 2007, when they finally positioned aggressively, the sector had already multiplied several times over. The pattern repeats because the institutional incentive structure doesn't change. And right now, in January 2026, that same dynamic is playing out in silver mining equities. The CFOs inside these companies, they're looking at January's realized prices. They're recalculating free cash flow projections. They're running sensitivity analyses that make their earlier guidance look absurdly conservative. But that information, those internal forecasts, they don't hit public filings until the earnings calls, which means there's a knowledge gap, not insider information, just a timing gap between operational reality and public disclosure and institutional response. The companies are printing profits right now. The earnings reports reflecting those profits come in 6 to 8 weeks. The analyst upgrades responding to those reports come 2 to 4 weeks after that. The institutional capital flows following those upgrades come over the subsequent quarter. Meanwhile, the mathematical reality exists today. $16 to $20 all-in sustaining costs. $113 silver, $93 to $97 profit per ounce. That's not a projection. That's current operational arithmetic. But Wall Street, conditioned by 2011 and 2020, trained to wait for confirmation, hesitant to look foolish again, they're still catching up. And that hesitation, that institutional memory problem, it's creating the opportunity that veterans recognize. But it also raises a harder question. What if they're right to wait? What if the skepticism isn't just psychological, but rooted in something deeper they're seeing in the macro landscape? That's where the analysis has to go next. There's a number that should terrify industrial procurement managers, but most investors haven't noticed it yet. 0. That's roughly how many major new primary silver mines have come online globally since 2018. Not a slowdown, not a modest decline, essentially flat. While the world has spent the last 6 years accelerating its consumption of silver at rates nobody predicted, the supply side has barely moved, and that disconnect between what industry needs and what mines can deliver, it's not temporary, it's structural. Let's start with the timeline problem. From the moment a company discovers a promising silver deposit to the day that mine produces its first commercial ounce, the average timeline runs 5 to 7 years, sometimes longer. That's in stable jurisdictions with established permitting processes. In places like Canada, Australia, parts of the United States, discovery, feasibility studies, environmental impact assessments, community consultations, permit applications, appeals processes, construction, commissioning, 5 to 7 years minimum. And that timeline isn't shrinking, it's expanding. Environmental opposition to new mining projects has intensified across developed economies. Community groups, indigenous rights organizations, conservation advocates, they're more organized and better funded than ever before. They're not wrong to demand accountability. Mining has environmental consequences, but the practical result, from a supply perspective, is that fewer projects get approved, and the ones that do take longer, which means the silver that industrial consumers will need in 2028, 2029, 2030, that supply should already be under construction right now, and it's not. Now layer on top of that timeline problem the demand acceleration that's underway. Solar panel installations. According to industry projections, global solar capacity is expected to grow 40% year over year through 2028. Each gigawatt of solar generating capacity requires approximately 30 tons of silver. For the conductive paste in photovoltaic cells, there's no commercially viable substitute at current technology levels. Copper doesn't work, aluminum doesn't work. The electrical conductivity requirements, the operating temperatures, the degradation rates over 25-year panel lifespans. Silver is the only metal that meets the specifications at scale, so as governments worldwide push renewable energy mandates, as corporate ESG commitments drive private sector solar adoption, As electricity demand from AI data centers forces diversification away from fossil fuel dependence, the solar industry alone is pulling incremental silver demand that wasn't in the system 5 years ago. Then there's electric vehicles. Each EV uses approximately twice the silver content of a traditional internal combustion vehicle. Battery management systems, charging infrastructure, power electronics, onboard computing. As EV adoption accelerates, particularly in China and Europe, where regulatory pressure is strongest, that's another demand vector layering onto the equation. 5G infrastructure. The rollout isn't finished. It's barely halfway complete globally. Every 5G base station, every network densification node, every small cell installation. They require silver for the high-frequency signal transmission components. Military and defense electronics, missile guidance systems, radar arrays, communications equipment, drone technologies, the Pentagon's modernization programs, NATO's equipment upgrades in response to geopolitical tensions. These aren't discretionary purchases that get delayed in budget negotiations. They're strategic imperatives, and they consume silver at rates that dwarf consumer electronics. Add it all together, solar, EVs, 5G, defense, AI data centers, these aren't cyclical demand sources that rise and fall with consumer sentiment. They're structural, driven by government policy, technological necessity, geopolitical competition, the kind of demand that doesn't reverse because interest rates rise 2%. Now here's where it gets more complicated. China produces roughly 15% of global mined silver, not the largest producer, but significant. And in late 2025, Beijing quietly implemented export controls on certain refined metals, including silver, under national security provisions. They didn't ban exports outright. That would trigger immediate international backlash. Instead, they introduced licensing requirements, strategic reserve accumulation programs, domestic priority allocation frameworks, the kind of bureaucratic mechanisms that don't make headlines, but fundamentally alter supply availability. This isn't speculation. It's documented policy accessible through Chinese Ministry of Commerce announcements, and it follows a pattern China has deployed before. Rare earth elements, where they dominate 90% of global refining capacity, they've used export quotas as geopolitical leverage. Cobalt, where they control significant processing infrastructure. Similar approach. Copper, increasingly treated as strategically critical, same framework emerging. If Beijing decides silver falls into that category, if they determine that domestic industries, domestic military applications, domestic technological development take priority over export revenue, then Western industrial consumers face a problem, because you can't simply replace 15% of global supply overnight. There's no emergency reserve you tap. There's no substitute material you switch to. You either secure alternative sources or you face allocation shortages. And the alternative sources? Mines in Mexico, Peru, Canada, Australia, the United States. Which brings us to the strategic dimension that most market analysis completely misses: friendshoring, supply chain resilience. These aren't just corporate buzzwords anymore, they're actual procurement mandates. The Pentagon, in its 2025 Critical Minerals Assessment, explicitly identified silver as a strategic material with supply chain vulnerabilities. The European Commission, in its raw materials security framework, flagged silver for diversification priority. Not because there's a global shortage right now, but because concentration risk, in a world of rising geopolitical fragmentation, creates unacceptable vulnerabilities. So, when a defense contractor needs silver for guidance systems, when a solar manufacturer needs supply certainty for a 10-year production contract, when an EV company needs to lock in materials for their 2027 model rollout, they're not just optimizing for price anymore. They're optimizing for reliability, for sources that won't disappear because of export license delays or strategic reserve diversions. And that shifts the value equation for Western Hemisphere producers. They're not just selling silver, they're selling supply security. In a world where that matters more than it has in decades, this is the structural foundation beneath the current price rally. Not speculation, not momentum trading, not retail enthusiasm, demand acceleration meeting supply stagnation, complicated by geopolitical fragmentation, the kind of setup that doesn't resolve in quarters, it plays out over years, but recognizing the structural thesis, understanding why silver rose from 65 to 113, that still doesn't answer the critical question. If the fundamentals are this strong, if the profit margins are this wide, if the supply deficit is this real, why is institutional capital still hesitant? What are they seeing, or what do they fear, that's keeping them on the sidelines? That's where the analysis gets uncomfortable. Every compelling investment thesis has a mirror image, a bearish case that's equally logical, equally data-driven, equally honest about what could go wrong. And the silver mining thesis, despite its mathematical elegance and structural foundation, carries risks that cannot be dismissed. Serious investors don't ignore these risks. They weigh them. They quantify them. They determine whether the potential upside justifies the documented downside. So let's examine what could break this trade, starting with the most immediate threat: technical resistance. Silver is currently testing a multi-year resistance zone between $100 and $110 per ounce. It's pushed through briefly, touching 117 in recent sessions. But it hasn't held convincingly above that level. Volatility has spiked, which historically signals either a breakout gathering momentum or exhaustion before a reversal. If silver fails to break through and hold above this resistance, if profit-taking accelerates and drives prices back into the 90s, the mathematics that created 100% profit growth reverses symmetrically. A 15% correction in the metal from 113 down to 96. That could easily trigger a 30 to 40% correction in mining equities, because operating leverage works both directions. When prices rise above fixed costs, profits accelerate exponentially. When prices fall back toward fixed costs, profits compress just as violently. This isn't a flaw in the thesis. It's the mechanical reality of leveraged exposure, and it demands position sizing discipline. Second risk, macroeconomic headwinds. The Federal Reserve's policy trajectory remains uncertain. If inflation proves stickier than current forecasts anticipate, if the Fed pivots more hawkish than markets expect, if real yields spike because nominal rates rise faster than inflation falls, precious metals historically struggle in that environment. Gold and silver thrive when real interest rates, adjusted for inflation, are negative or near zero. When holding a non-yielding asset costs nothing in opportunity terms, but when 10-year Treasury inflation-protected securities, TIPS, push yields back above 2%, the calculation changes. Suddenly there's a measurable cost to holding silver instead of risk-free government bonds and institutional capital, which operates on relative return frameworks, rotates accordingly. This isn't theoretical. It's precisely what happened in 2013 when the taper tantrum drove real yields higher and crushed precious metals. Third risk, supply-side surprises. High silver prices, sustained above $100, create powerful incentives. Mining companies with marginal deposits, projects that were uneconomical at $70 or $80 silver, they start running the numbers again. Restart costs get justified. Expansion projects get greenlit. Secondary recovery operations become viable. Not enough supply to erase the structural deficit. The timeline problem, the permitting delays, those don't disappear. But enough incremental supply could hit the market in late 2026 or early 2027 to slow the pace of inventory drawdowns, to ease some of the physical tightness that's supporting current prices. And if that happens, while industrial demand plateaus, even temporarily, prices could stall. Fourth risk, operational execution. Even if silver stays elevated at $100+, even if the structural deficit persists, even if geopolitical supply constraints tighten further, individual mining companies can still destroy shareholder value through mismanagement, cost overruns that blow through budgets, permitting delays that push production timelines out years, labor strikes that halt operations, environmental incidents that trigger regulatory shutdowns, geotechnical failures when the rock mechanics don't behave as the engineering models predicted, flooding, seismic events, metallurgical recoveries that underperform feasibility study assumptions. The history of mining is littered with world-class deposits that generated negative returns for equity holders because the metal's price, while necessary, isn't sufficient. Operational competence matters. Management capital allocation discipline matters. Balance sheet strength matters. A company with exceptional assets, but over-leveraged with debt, can be forced to liquidate positions at the worst possible time. These aren't abstract risks. They're documented failures that have bankrupted companies and wiped out shareholders. So anyone considering exposure to this sector, they need to understand they're not buying a risk-free arbitrage. They're accepting volatility. They're accepting execution risk. They're accepting macro sensitivity. But here's the critical reframe. Every single one of these risks, legitimate as they are, represents delay or temporary headwind, not structural negation. Technical resistance gets resolved. Either silver breaks through or it doesn't. But the supply deficit doesn't disappear because of a chart pattern. Macroeconomic policy shifts create volatility, but they don't eliminate industrial demand for solar panels, EVs, 5G infrastructure, defense electronics. Those technological and geopolitical drivers operate on longer timelines than Federal Reserve meeting cycles. Supply-side surprises could materialize, but 5 to 7 year permitting timelines don't compress because silver hit $113. The projects that might come online in 2027, they should have started construction in 2022 or 2023, and they didn't. Operational risks are real, which is why due diligence isn't optional. Why investors need to verify all-in sustaining costs through technical reports, not marketing presentations. Why balance sheet analysis matters. Examining debt levels, liquidity, covenant headroom. Why reserve life and ore grade profiles need scrutiny. Looking for 10-plus year mine lives at current production rates. Why diversification across multiple assets reduces single-point failure risk. And why distinguishing between producing companies with actual cash flow and operating leverage versus exploration stage companies with binary discovery risk is absolutely critical. Because those are different risk profiles entirely. But for investors who do that work, who position size appropriately for volatility, who accept that 30 to 40% drawdowns are possible, who understand they're playing a multi-year structural trend, not a 3-month momentum trade, the asymmetry calculation becomes compelling. Because the bearish scenarios, while plausible, don't negate the thesis. They delay it. They create volatility that shakes out weak capital. They separate serious long-term positions from speculative momentum chasing, which is exactly what Rick Rule has built his career understanding. He didn't generate wealth by selling every time markets pulled back 10%. He generated wealth by distinguishing between noise and signal, between cyclical corrections and structural shifts, between temporary setbacks and permanent impairments. And right now, in January 2026, silver at $113 and climbing. Mining stocks up 50 to 100%, while profits rose approximately 100%. Wall Street still catching up to the new reality. Structural deficits widening, geopolitical supply risks escalating, operating leverage doing exactly what the mathematics predict it should do. The risks are documented. The volatility is guaranteed. The execution uncertainties are real, but the fundamental disconnect between profit growth and equity valuations, it exists, and it won't persist indefinitely. Either the stocks reprice higher to reflect the earnings, or the earnings collapse because silver reverses. One or the other resolves the gap. The question every investor faces isn't whether risks exist, it's whether the probability-weighted upside, given the structural foundation and mathematical leverage, justifies accepting those risks. That's not a question anyone else can answer. It depends on capital availability, risk tolerance, time horizon, conviction in the structural thesis. But the framework for making that decision, the data, the mathematics, the risks, the asymmetry, that's what separates informed positioning from speculative gambling. And that's why veterans like Rick Rule smile, not because the trade is risk-free, but because they've seen this setup before, they know how it typically resolves, and they understand that institutional capital, by the time it arrives with full conviction,